Our next guest also focused on this earnings season, saying Q1 results will be important, but guidance will be key. Let's bring in our friend Liz Ann Saunders, Chief Investment Strategist with Charles Schwab. Liz Ann, welcome. Good to have you with us. Let's talk through the earnings season that is coming up. What will be the telltales for you? What are you looking for? What are you looking to hear and not hear?
Yeah, I would almost put air quotes around the guidance piece of it, because I'm not sure we're going to see a significant surge in companies that re-up precise quarterly guidance. Even pre-pandemic, we were on a trend toward companies moving away from quarterly guidance with specificity to analysts. And quite frankly, I think that's probably the right thing. I don't think corporations should run themselves on a quarterly, cents per share metric, but just in general, the outlook for their business into the latter part of this year, and then to look and see what analysts' reactions are. Remember, in the absence of any guidance, formal or otherwise, last year, when analysts were left to their own devices, they erred on the side of lowering the bar. And we had 3 quarters in a row of very high beat rates. So much so in the fourth quarter that we actually moved into positive territory year over year. I think 25% is the consensus for Q1, 50 some odd percent consensus for Q2. We're going to start to get a sense of whether those are valid numbers. And obviously, that's the plug into the forward PE in terms of the denominator. So I think it's going to be an important tell.
Let's talk a little bit about the Fed and what it is likely to do, or more precisely, maybe not do. How do you interpret where the Fed is right now? And certainly, Jeremy Siegel in the last hour or so said he interprets what the Fed is saying as this is the dovish Fed chairman he's ever seen. What do you think?
I think that's pretty valid. And I'm not sure that it's just specific to Powell. I have to think that if his predecessor, now Treasury Secretary Yellen, were in the same position, and given some of her comments made now as Treasury Secretary, I think we would have a pretty dovish Fed regardless of who was at the helm. And that's a function of, obviously, the change to half of their mandate, the inflation mandate, thinking of it as an average, and very explicitly saying they're willing to let it run hot. But also, interestingly, and less focused on, is the more subtle adjustment they've made to the employment side of their mandate, which Powell's been very vocal about in talking about. It's not just a decline in the unemployment rate that they're going to be looking for before tightening policy, but breadth and equality associated with that. So they want to see that a pickup in the labor market and lessening slack in the labor market is fairly broad in terms of industries and income levels. And it's not just simply the unemployment rate that's going to be a factor. So there's been changes to both mandates that I think are really key to thinking about how the Fed's going to react in the next year or so.
Shepard Smith here. Thanks for watching CNBC on YouTube.